guys, welcome to the video podcast. Today is May 17th, and this is Through a Trader's Eyes video podcast. Going to differentiate the two. Of course, we've got the Eggers Report, which is our radio show, and then we've got the Through a Trader's Eyes video podcast. So the video podcast always available on the website, and of course, you can also it's on YouTube as well, and then the radio show, the Eggers Report, is also available. That is available through iTunes and a few other places. All of these things, of course, if you just go to our website, eggerscapital.com, on the right side, there is an alerts button. You can click on that, and anytime we do, whether it's a radio show, video podcast, an article, anything like that, it's going to appear on the website, and then consequently, if you have your email address in there, it'll just come to you whenever we post one. So if you'd like to get on that free alerts list, you can do so. Nothing salesy in there, just a bunch of information sent to you maybe 2 times a week or so on average. And we do these video podcasts essentially when I have time. And this is the first one we've done in maybe a couple of weeks, but wanted to get this out to you as we've had a little more volatility here recently. And as you can see from the screen, you know, the S&P, if you were to look at this, you would say, hey, I see what you're seeing. I see that line you're drawing, Karl. And remember, this high that was put in here in let's call it 2015, and then we had the big drop in the middle of the summer of 2015, only to see a rally, another drop early in 2016, a little lower, and so we're making these lower highs, and I think that's really the issue here, and really the concern is that you had a high here, you have a high here, and all these are lower highs. Well, here you can see we kind of broke out a little bit, and there was some optimism that maybe we would go up to all-time highs and break out above. So far, that has not happened. Now, I did point out on Twitter, I'm at Karl Eggers is my handle, and on Twitter today I did point out that the 50-day moving average has been providing support. I want to clarify something. If you look at many of you have different ways to look at charts, and if you notice here, this looks like it's below my 50-day moving average. Some are calculated using the simple moving average, some are exponential, and so it just depends on which system you're looking at. If I was to look on a different system, you could see it's been providing support, whereas on this particular system, it actually looks like it's broken down. Regardless, it's kind of splitting hairs. It's kind of hovering around that 50-day, and you can see the 50 days actually started to roll a bit. But we seem to be stuck in this box, and I think there is a little support here, and it's really right in here. So let's call it the old high, and we'll call it basically from 2,000 down to 2,100, 2,150, something like that. So we're in this little range here. And it definitely appears that we are rolling over, and that's not too scary. That's basically just to say, hey, it looks like we're going through one of these, right? I'll try to draw here, freehand. I mean, how can this not look like we're heading down? And I think that is why be prepared for something maybe different. It could be that we just move sideways. If you kind of zoom in here the last few days, you know, we had this really nice. Let's put a little support there. We had this nice little bounce. I guess it was last Monday or so, and then that reversed, and then we just went down Tuesday, Wednesday, Thursday, and actually, I'm sorry, Tuesday we had that nice up day. Then Wednesday, Thursday, and Friday we had 3 down days. We came back yesterday, had a really nice up day, and then today just gave it all back. So, you know, we're getting more volatility. We've had probably 4 out of the last 6 or 7 days that the Dow's been down, you know, or up 175 to 200, somewhere in there. So we're definitely getting some more movement, but we are still kind of moving sideways. I mean, yes, you do have these moving averages. This green line's a 20-day moving average, and you can see it's kind of rolling over here. So definitely the path of least resistance does seem to be down. And part of it today, if you're look at, this is a 5-minute chart today, and so you can see here's where we opened up here, and kind of moving sideways, and then things started to accelerate to the downside. Part of that, from what I understand and see, is that some Fed presidents came out, and it was perhaps we're on pace to have a rate hike in June. I still think the odds of that are slim, but there are some inflationary numbers starting to pick up steam, and perhaps it's out of the Fed's comfort zone, but growth is still very mediocre and still decelerating a little bit. So, I don't think they're going to do anything, but the market still fears that, and it could be just a little temper tantrum. But we definitely saw the selling accelerate into the down, into the close today. And you got the Dow Jones finished down about 180 points, 1%. You got the NASDAQ down 1.25%. The S&P was down about 1% as well. On the upside, commodities. You see commodities were up about 1% today. This is the Dow Jones UBS Commodity Index. That had a good day. Junk bonds were flat on the day. Mid caps, small caps got hurt a little worse than the large caps. One of the things that got hit pretty hard was utility stocks. They had a little bounce last couple ticks, but they got hit. They were down almost 2%. And REITs. So they got hit. And what was interesting was, even though interest rates were down on the day, not a bunch, but they were down, usually REITs and utilities are going to have some upside there. And they didn't. They were actually down today. So we saw it was kind of interesting today, though, because what we've been noticing here is you're getting this, and I'll switch back to daily view, but you're getting this move, which we've been saying for a while, consumer staples, and then we'll just pull it up. Let's pull up the XLP, which is the ETF for consumer staples, and you can see they broke out new highs just a few days ago. They were down almost 2% today. This area right here, and it has about a 2.4% dividend. This area is a very expensive sector right now, and it's made sense why it's been doing this, because it pays a dividend. These stocks are theoretically recession-proof, blah, 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 but they're very expensive. Same thing with utilities, same thing with some REITs. Some of these areas are expensive. So what you saw today is, depending on what you own, some of the beaten down stocks, especially on the NASDAQ, held up and were very green today. The E&P stocks were green on the day. You had natural gas was up on the day. Just some areas. Ag stocks were up today. Agricultural commodities up today. You had some NASDAQ stocks up that we talked about. So there was a rotation from the expensive stuff down to the cheap stuff. I don't know if that can continue or not. I think it should continue. But are we seeing, after all these hedge funds had to report their earnings, their holdings, are we seeing them start to rotate into take money off the table in some of these areas? We saw AT&T. Remember Warren Buffett. If you take a look here, Warren Buffett sold his AT&T, right? It's near a high. He also sold his Procter & Gamble. Okay, Procter & Gamble, another one yielding 3.2. These stocks are expensive, even though they're not necessarily at their highs. They're very expensive. And then what did he put money into? IBM, okay, which IBM is very cheap right now. PE of 11, almost a 4% yield. Still about 17% off its 52-week high. He also bought, which you knew this, he bought Apple. He says he didn't buy it. One of his guys did. I guess he was out of the office that day and they bought it. Somebody joked around on Twitter commenting that perhaps Warren came in and thought he bought some kind of candy Apple store, because technology is not really his forte. But they did buy Apple. Obviously, he, I'm sure, approved it. But he's going in there trying to buy these stocks. I mean, look, Apple is down, probably somewhere around 30% from its high. And we like it here a lot. So he's going in and shifting that. So maybe we're starting to see some rotation. One of the things that's been hit hard, of course, is retail. And you can see this just from, maybe a couple weeks ago. It's down about 10%, still in this, rolling over potentially. And if you take a look at it weekly, you'll see here retail's had a great recovery since 2009, right? And that makes sense as the economy recovered. But now what you're seeing is perhaps this thing's starting to maybe roll over a bit. So it was in this solid uptrend, and then can it be doing that potentially? So retail, but remember, it's not all retail. If we take a look at within retail, Amazon, all-time high basically in Amazon. So it's just that when you take a look at some of the the coals. Again, these are weekly pictures you're looking at. Down somewhere around 55% from its high. A lot of these companies are struggling. If you look at Macy's, same picture. If you look at J.C. Penney's, of course they've been going through a lot of issues for a number of years, but still scraping the bottom here. Nordstrom's, JWN, same picture. So, and we wrote an article on the website the other day, eggerscapital.com, outlining that this is happening right now. This shift of online is happening. We knew it would happen, but it's very obvious that it's happening right now. So you're seeing Amazon at new highs, all these other stocks at new lows. End of story. Very easy to understand that what's going on. So retail is another area that's been hit. Let's take a look at gold real quick. Let me switch back to the daily picture here. So gold, you can see it had a nice start to the year, and kind of has broken out of this little wedge here. Broken out, looked like it was going to start pulling back, and now it could be starting another little leg up. And pardon the lines, but you'll see a little wedge here. It broke out and could be doing the same thing here, breaking out again. So gold does look interesting. I'd like to see it pull back a little more, but you are hearing about more and more people buying more gold. Maybe they see inflation picking up. Maybe it's a Fed move. We'll see. Silver, same kind of picture. Big move for silver from the bottom, about 27% this year so far, and only about 4% off its high. I'd like to see these things pull back a little more. Maybe 6-7% pullback would get me interested. But you are seeing again interest rates kind of scraping the bottom, and that's kind of the concern right now. If you look at the 10-year, it's near the bottom, hovering around 1.7, 1.6%. And again, if you take the 10-year minus the 2-year, that's the yield spread. You want to see that thing getting bigger, and what's happened is it's getting smaller, which tells you people are still concerned about the economy. So you got this issue right now, and it's pretty clear to see the bond market's pricing in that the economy's sucking wind. People are worried about the Fed raising rates at the same time the economy's weakening, right? That's a bad combination. And you have earnings that are flattening out and actually going down this quarter. And so that's a bad combination because stocks aren't necessarily cheap on a valuation basis. I think there are pockets that are. I think that there are plenty of stocks that are still. So you don't have this completely frothy market. But I think the froth is in the heavyweight stocks. So the ones that make up the heavyweight in the S&P, those are the expensive stocks. So the S&P is the most vulnerable. So if you're going to be in S&P type stocks, at least make it an equal weight or a fundamentally based ETF, something like that. But this combination of earnings rolling over and the Fed not being as accommodative as they were, it's no surprise, and again, we've pointed this out many times, but it's no surprise if you look back to, let me switch this to a weekly picture here. Remember, this drop in 2014 here on the S&P from high to low was right around 10%, okay? That was the very first time that the Fed ended QE, okay? And I'll put a little marker right there. So that was when they ended QE. Okay, market sold off the first time. That was kind of your first, something wrong here. And remember, this little uptrend was broken right about there. So that was your Then we went up a little higher. Then we had last summer another flash crash. Then we come into January. This thing's really broken. And so we have essentially been moving sideways for almost 2 years now. Okay. And that's a very frustrating market, makes things very difficult. And so, but it's no secret that if you look, earnings have flattened out, and on top of that, the Fed ended QE here. So, what's going to make it go higher? Well, earnings either pick up, the economy picks up, or things get bad enough and the Fed says we're not going to raise rates. In fact, we're looking at doing another round of quantitative easing. All of a sudden, the market could take off again. It's a sad commentary, but that's what could happen. And so, but this picture here, you look at it and go, does this look like it's rolling over? Yeah, it kind of does, but it could just be moving sideways too, as well. So that's kind of what's going on in the big picture. But I would say in the very short term here, again, don't overtrade. I think that you should be, as we've been reiterating numerous times on our radio show and here, this is where real diversification comes in handy. Because you wake up yesterday and you're like, man, the Dow's up 200 points. I'm glad I got some stocks. You wake up today and say, boy, I'm glad I don't have all my money in stocks. And the key is to have some things that have nothing to do with the stock market in your life. Real estate, commercial lending, commercial real estate, residential real estate, whatever it is. There's lots of different ways to play that. And we've got tons of different alternative investments that we use for clients depending on the situation. You combine that with perhaps some cheap dividend stocks that are growing their dividend, been around forever, but on the cheap side. And then you mix in maybe some trades, some value stocks, some sectors that are doing well. We pointed out on Twitter the other day, we own the agricultural ETF, DBA. Really, really like this setup quite a bit. And if you look at it on a weekly basis, you can kind of see it even further. But you see how it's kind of turning the corner here. And we think this thing can go higher. It's not a really volatile. I mean, it was up 0.3% today, but it's something that is working in this environment right now. And from the February lows, it's up about 10%. But again, I don't think you'll get killed in this if it goes the wrong way. But I do think it's something that can continue higher. And then if it rolls over, we would take profits in that. So that's something that is working right now. But you have stuff like that going on in your portfolio. But keep the income coming in. So you got the income, you got some trading, maybe some long-term core positions. If you want to buy individual stocks, you buy some good brands perhaps when they're on sale, like an Apple. I think Apple right now, not from a trading perspective, but the fact that it broke down and all these big activist guys and these hedge fund guys are getting out of it, they've already done their selling. Remember, they tell you about it after they did it. So the fact that it broke down, everybody's questioning, Apple long term, that's when you want to buy these great brands. So to me, it's a no-brainer. You buy it, you put it away, done deal. They're going to keep raising their dividend. $50 billion in profits a quarter. It's ridiculous. And you're getting it 30% off it was. So, do they have issues to work through? Absolutely. But is it a stock that I would be buying right now, especially in a dividend portfolio? No question about it. So I think that's how you put a portfolio together. Some of you can only afford to do one or two different types of strategies. That's fine. But I just think from the big 30,000-foot view, you have to have a lot of different moving parts in order to be successful over the long term, because there's going to be periods where trading does not work. There's going to be periods. Right now, I think we're in a period which is really interesting. I think we're in a period where this picture here, this S&P, which looks like it's near all-time highs, the average stock is not near an all-time high. So there's a lot of stocks that I think are ultra cheap, and yet they're not getting rewarded, whereas the things that are expensive continue to get rewarded, primarily because they are more recession-proof and they have a high dividend, but their valuation has gotten ridiculously overpriced. So there will be a price to pay for that at some point. But I still like energy, pockets of energy. I still like certain commodities. I still like certain tech stocks that are cheap. I still like emerging markets. And I still think there's plenty of things to do in the commercial real estate area. But there are huge bubbles in certain areas. But in others, there are still some great deals. And so there's lots of ways to do all of this. And you just got to figure out what's the best way for you and what makes sense. Some of you don't need individual stocks. And that's why we show you individual stocks on here. We show you sectors. We show you the stock market overall. And, but it is, this grind may continue for a while. And that doesn't mean, I think this all or none mentality that people have, they need to get rid of that. That doesn't, just because the stock market starts to go down doesn't mean it's going to zero. And just because it may break out to new highs, that doesn't mean we're in a new bull market either. So again, we're in an area right now, the market's still addicted to the Fed. The Fed's giving mixed signals, and earnings aren't going up right now, and that's a problem. So can earnings start to go up? I think perhaps the dollar going down. Remember, the dollar has been going down. So that's why oil's done better. Oil's pushing $50. And, again, if you take a look at oil here, you can see that's looks much better than it did back in February. Oil has gone up roughly about 80%. It was at $26. It's at almost 50. It's a nice little move there. But I think if you look at the dollar itself, remember, it went up. And the fact that it went up so much in 14 and 15, That was a big headwind for a lot of these big, companies, these international companies. Now you've seen the dollar fall about 5-6%, which doesn't sound like a lot, but that is a big move in a currency basket of currencies. The fact that that's falling could be a tailwind. So next quarter, when this quarter's over, look for some of these big conglomerates to start beating earnings estimates because the dollar is now a tailwind, not a headwind. And again, the dollar moves gold. It moves a lot of different commodities, including oil. So watch the dollar, because everybody thought the dollar was going to continue to go up. And as soon as the Fed raised rates, the opposite happened. Everybody thought the dollar would go higher when the Fed raised rates. Remember, the Fed raised rates in December. The dollar's down about 6%, 5 or 6% from that point. So it had the reverse effect, which is really interesting to watch. So a lot of moving parts right now. Bottom line is stock market still looks like it may still be completing this little minor correction. And what we need to see is the fear start to pick up, and then you may get a buying opportunity. But don't overdo it right now one way or the other. All right. Hey, don't forget, eggerscapital.com is the website, twitter.com. You can go to Twitter, but you can also go to @KarlEggers is my handle. Our telephone number is 210-526-0057. And we'll talk to you next time we do a video podcast on Through a Trader's Eyes. Thanks a lot, guys. Take care.